What if I told you that the worst thing that could possibly happen to you today is that your next trade makes you a massive amount of money? Most people think red days are what destroy trading accounts. They think it is the slow bleed of tiny losses, or the sudden violence of a market crash, or some mysterious algorithm designed by a billionaire to hunt their specific $12 stop loss. They are wrong. There is a very specific type of green day. It is a toxic, rule-breaking wind that acts like a Trojan horse in your brain. It sneaks into your psychology, silently rewires your nervous system, and mathematically guarantees that a few months from now, your entire account balance will drop to zero. The market does not kill you when you lose. It sets a trap by letting you win. Today we are looking at the silent killer of profitable traders, the one good trade illusion. I know exactly how this happens because I used to watch it happen in real time. When I worked as a data analyst for a prop firm, I had unrestricted access to the back-end servers. I analyzed the raw data of thousands of funded traders to find the exact mathematical difference between the 1% who actually withdraw money and the 99% who burn their accounts to the ground to feed them. I took that classified data and put it into a book. There is no motivational fluff. It is pure mechanics. First, it gives you the unrestricted server data. I lay out exactly what the top 4,000 traders actually do, their exact win rates, risk-to-reward ratios, trade durations, and strict daily loss limits. Second, it gives you mechanical control strategies. These are practical step-by-step rules to put your brain in a straitjacket, force patience, and physically stop overtrading dead in its tracks. And third, it gives you a survival guide for drawdowns, showing you the exact mindset shifts the top 1% use to not panic when the screen bleeds red. It is time to mechanize your mind. The link to grab your copy of the book is in the description. Every blown account starts on a completely average Tuesday. You sit down at your desk, you have your coffee, you have your charts open. You drew your little lines and your Fibonacci spirals. You are a disciplined, logical participant in the global financial markets. You enter a standard trade based on a proven setup. You have your risk management set in stone. The rule is a strict 1% loss. If the price hits that invisible line, you accept you were wrong, you take the tiny loss, and you move on with your life. Then the line goes down. It does not go up like the guy on YouTube promised. It creeps toward your stop loss. Slowly at first, and then with a sudden jerky aggression. You are supposed to let it hit the stop loss. That is the rule. But as the little red candle gets closer, a very specific feeling forms in the pit of your stomach. It is not a financial feeling, it is a biological one. Your ego simply refuses to accept the loss. Admitting you are wrong is painful. Society punishes us for being wrong. Schools fail us for being wrong. Bosses fire us for being wrong. So your brain treats this tiny red candlestick not as a business expense, but as a physical threat to your identity. So you do something entirely rational for a human being in pain. You move the stop loss down. Just a little bit, just to give the trade some room to breathe. You tell yourself it is just market noise. You tell yourself the big banks are trying to shake you out before the real move happens. You construct a brilliant, complex narrative about macroeconomic factors and interest rates to justify why you are ignoring the bright red warning light flashing on your screen. You have officially abandoned logic and entered survival mode. You are no longer trading the chart, you are trading your ego. The price keeps dropping. It drops past your new adjusted stop loss. You are now in a massive drawdown. The 1% loss has become a 5% loss. You are staring at the screen, sweating through your shirt, with the heart rate of a hummingbird on espresso. You are negotiating with a god you have not spoken to since childhood, promising that if you can just get back to break even, you will never ever break your trading rules again. Statistically, this trade should crash and burn. It should hand you a painful, well-deserved financial beating. It should wipe out a chunk of your capital and teach you a lesson about risk management that you will remember for the rest of your life. But then, the market does something terrible. By pure, blind, statistical luck, the market violently reverses. Some guy in a glass tower in London sneezed, accidentally hit the buy button on a massive block of shares, and the price rips straight up. It blasts past your entry point. Your negative red numbers instantly turn into a glowing, beautiful green profit. You close the trade. You lean back in your chair. The relief washing over you is intoxicating. You did not just survive a near-death experience. You made money. You close your laptop feeling like an absolute financial genius. You just ruined your life. Why is this specific win so incredibly dangerous? On the surface, you made money. Your daily profit and loss statement looks great. You can take a screenshot and show it to your friends. But on a deeper, invisible level, you just successfully avoided the psychological pain of being wrong, and you got paid to do it. Neurologically, your brain just secreted a massive, overwhelming dose of dopamine to reward you for escaping a high-stress, dangerous situation. Your brain does not care about your trading journal. It does not care about your risk management spreadsheet. It does not care that you read a book about trading psychology. Your brain only cares about not dying. When you broke your rule, and it resulted in safety and profit, your brain wrote a new line of code. It permanently wired rule breaking as a highly effective survival strategy. If you put a rat in a maze, it will eventually learn the safe path to the cheese. But if the rat figures out it can just jump over the maze wall, grab the cheese, and not get shocked, it will never run the maze normally again. It will jump the wall every single time. Human psychology in financial markets works exactly the same way. You haven't discovered a new strategy. You have just been positively reinforced for toxic behavior. This is why brand new beginners are actually safer than amateur traders. A beginner is terrified. They use small size. They follow instructions. They have no bad habits because they have no experience. But an amateur who just made a month's salary using terrible, reckless risk management has survivorship bias. Their green profit acts as a protective shield against learning the right way. A beginner makes mistakes because they are confused. An amateur makes mistakes because they are confident. A very confident mistake is the most expensive thing on earth. Now that you have survived this terrible trade, you have to justify to yourself why you did it. You cannot admit that you panicked and got extremely lucky. That hurts the ego, so you construct a myth. You tell yourself a lie. You say, "I did not break my rules. I just used my advanced market intuition." You look at the green dollar amount in your account as concrete proof that your gut feeling was right. You start believing you possess a magical sixth sense for price action. You think you can feel the rhythm of the market. You are a hairless ape staring at a glowing rectangle of changing pixels, but you convince yourself you are reading the Matrix. Getting away with a bad trade is exactly like driving home drunk and arriving safely in your driveway. You did not suddenly become a highly skilled drunk driver. You just got incredibly astronomically lucky. The police were not on your street. You did not hit a tree. You survived. But because you survived, and you woke up in your own bed, your brain logs the event as a success. You are infinitely more likely to do it again next weekend. You will keep pushing it, feeling invincible, until the math catches up with you. The road rewarding you for a fatal habit is a delayed death sentence. The market rewarding you for moving your stop-loss is the exact same thing. A few weeks pass. The dopamine hit from the miracle trade starts to fade. You are back at your desk. You enter another standard setup. Once again, the line goes down. The trade goes against you. But this time, the internal monologue is different. The fear of moving the stop-loss is completely gone. You do not feel the cold sweat. You do not feel the cold sweat. You do not feel the cold sweat. Because of the previous dopamine hit, you do not even hesitate. You grab the stop-loss line on your screen and drag it into the basement. You decide to average down. The price is cheaper now, so buying more makes mathematical sense, right? If it was a good idea at $10, it is a brilliant idea at $8. You double your position size. You are aggressively leaning into the bad behavior. You are now playing a game of financial Russian roulette. You assume the gun is completely empty simply because it clicked empty the first time you pulled the trigger. You sit back and wait for the miracle reversal that your brain now expects as a natural right. But the market is not your mother. It does not care what you expect. It does not hate you. It does not want to steal your money. It just does not know you exist. The day of reckoning finally arrives. The market enters a true, undeniable, one-way directional trend against your position. There is a real macroeconomic catalyst. Real institutional money is moving. Every technical indicator on your screen is screaming at you to sell. The volume is heavy. The candles are massive and dark red. You ignore all of it. You rely entirely on your new toxic strategy of holding and hoping. You stare at the screen, waiting for the bounce. The London guy is not sneezing today. The bounce does not come. The price drops another 10%. Your account margin turns orange. You start looking for news articles to justify why the market is wrong. You suddenly shift your identity. You entered this trade as a 5-minute scalp based on a momentum indicator. Now, You are reading annual earnings reports and telling yourself you are a long-term value investor, gathering assets at a discount. You will hold this for 5 years if you have to. You will pass these shares down to your grandchildren. The price drops another 20%. The margin bar turns deep red. You cannot average down anymore because you have zero buying power left. You are trapped in a burning building, and you gave away the only fire extinguisher 2 weeks ago because you thought it was too heavy to carry. The market continues to grind your account down. It is a slow, agonizing suffocation. It takes hours. You watch months of hard work, discipline, and careful savings evaporate in real time. You feel sick. You feel a heavy, hollow void in your chest. You realize, with absolute clarity, that you did this to yourself. Then, the final automated email arrives. Your broker does not care about your intuition. The computer executes a forced margin call. It liquidates your entire position at the absolute bottom of the move. The screen goes blank. Your account balance reads 0. The market did not destroy your account today. The market just executed a delayed death sentence that you signed and authorized weeks ago, on the day you took that one good trade. You died the moment you learned to love the poison. The system is rigged against human nature. Everything you are naturally wired to do, avoid pain, seek comfort, double down on your beliefs, trust your gut, is the exact opposite of what is required to survive in an environment governed by cold probability. You are not stupid for blowing your account. You are just acting like a perfectly normal human being inside a machine designed to harvest normal human beings. So, if making money can actually destroy you, how do you survive in this game long term? How do you fix a brain that naturally wants to reward bad behavior? Most people believe green is good and red is bad. They measure their success entirely by the dollar amount at the bottom of the screen. If they are up $500 for the week, they are a good trader. If they are down $200, they are a bad trader. This is a profound misunderstanding of the job. A green profit on a trade where you broke your rules is a disease. Professional, consistently profitable traders do not feel joy when they make money on a mistake. They literally feel angry. They feel disgusted with themselves. They know the psychological damage that a toxic win causes. They know that keeping that money is like keeping a rabid dog in their house. It might be quiet today, but eventually, it is going to bite them in the throat. You must learn to grade yourself entirely on execution, not on the outcome. You do not control the outcome. You do not control the central banks. You do not control algorithm changes. You only control your entry, your position size, and your exit. That is the entire scope of your power. A winning trade that broke your rules is a terrible trade. A losing trade that followed your rules flawlessly is a perfect trade. You have to rebuild your dopamine system. You have to learn to mentally punish yourself for toxic wins. If you break your rules and make money, you should force yourself to withdraw that money and give it away. Give it to charity. Give it to a stranger. Do not let your brain associate that specific money with personal reward. And on the flip side, you have to learn to celebrate disciplined losses. When you take a 1% loss exactly where you planned to, you should feel a deep sense of pride. You executed the plan. You took the hit like a professional. You protected your capital. You survived the day. The loss is just the cost of doing business, like paying the electric bill for your store. You do not cry when you pay the electric bill. You just pay it so you can keep the lights on and keep selling goods. Trading is not about predicting the future. It is about managing the present so perfectly that the future does not matter. Your psychology is your true account balance. The money is just a reflection of how well you protect your mind from the illusions the market feeds you. You do not need more indicators. You need a digital straitjacket. That is what the Alpha Equity Manager does. You tell the software your daily limit is a 2% loss. The second your account hits -2%, the machine takes over. It does not ask about your intuition. It market closes every open trade and physically disables your buy and sell buttons for the rest of the day. You are locked out. If your panicked brain tries to go into the settings and change the limit to 3%, the time-locked vault rejects it. You cannot cheat it. It even calculates your exact dollar risk before you ever click the mouse. The link to download it is in the description. Stop trusting your emotions and let the machine protect you from yourself. The next time you are in a trade and it goes against you, the next time your hand hovers over the mouse, tempted to drag that stop loss down into the dark, stop, take a breath. Remember the rat jumping the maze. Remember the drunk driver pulling into the driveway. Do not ask for a miracle. Take the tiny loss. It is the best investment you will ever make.